fellow investors, fellow traders, prospective investors, prospective traders. Welcome to this third episode of RIVEM Outpace FS. My name is Alex Armagon. I am an investor. I am a trader. If you'd like to know more of my background, I encourage you to look at one of our previous videos. We're on to episode number 3. And in this episode, I'd like to touch on at least 4 themes before we move forward into this series. And RIVEM as a brand, if you're unfamiliar, is a brand centered on retail investing and retail trading, but from an international perspective. You may be familiar with some of our previous content under the Georgetown Capital, and you will be seeing some familiar faces from the Georgetown Capital also presenting to you content related to this retail trading, retail investing universe. And that should be in the coming months. And you will also see on this particular series, I'm working to get some very well-renowned names and familiar faces that you may know onto this particular series. Right, so the 4 themes that I would like to address today before we move forward. One is related to, and let's start with this, 2, I think, key questions that, depending on how you answer them, may lead to a barrier to investing if you are at this prospective stage, if you're thinking about retail trading, retail investing. And these are questions that I have arrived at from my exposure, and I've had a unique exposure when I came back to Guyana in 2019, and I was the head of the University of Guyana's energy think tank in collaboration with the Ministry of Finance at the time when we were standing up the country's first sovereign wealth fund. That's a 2019 version of the Natural Resource Fund. We had several conferences and sensitization meetings, and I had the pleasure to speak on the fund, the mechanics of the fund inflow, and the withdrawal mechanism. And from those interactions, whether the conferences or the sensitization meetings, individuals would have asked questions, and I could group them, the common questions, into 2 main categories. One addressed market volatility, and the second addressed market cyclicality, right? Volatility, let's touch on volatility first and foremost in terms of these key questions. Now, volatility in itself is not bad. Volatility is only bad when you focus on your ability to lose and you ignore that you could achieve a high expected return in a more volatile market once you implement your risk management techniques and your risk management mechanisms. But what is volatility? So volatility is when the frequency of price movements is high over a short term, right? That is volatility. And volatile market, the crude oil market is a volatile market, and gold has a much lower vol. If you think of it from a securities perspective, bonds has a lower volatility than stocks on average. And again, volatility in itself is not bad. If you are an investor and you have that risk appetite or you want a high expected return, volatility should not scare you away. But what you should learn is the more disciplined, rigorous process. And this is something I mentioned in the previous episodes. And you need to be aware of your risk management mechanisms, your risk management techniques. All right. So that's the first key question that I like to touch on. And then the second one relates to market cyclicality. And Howard Marks is a tremendous resource on market cycles, and I would encourage you to find content from Howard Marks. He's a very respected institutional investor. He's from the US, so I would encourage you to find content from Howard Marks. He has good books, several good books. Right, I pause because I have one of his books in my collection that I'd highly recommend. Mastering the Market Cycle, Howard Marks. Very good read on cyclical factors and the economy. He has a nice quote that states, most natural things have a birth and death cycle. And the investor psychology has a very pronounced cycle of rising optimism and price appreciation, followed by a rising pessimism and price declines. Very important for us to remember as businessmen, as investors, as traders, that this is a cyclical life. Life is a cycle. And when we have good times, we must also remember that we need to be prepared also for bad times that will inevitably arrive to our shores. Right? So the economy has a secular trend. It has a short-term cycle and it has a long-term cycle. Expansion years will inevitably be followed by recession years. And these oscillations around the secular trend, such as the positive secular trend in the United States, will cancel out over the long run. And I would say as well, the positive secular trend of the Guyanese economy. And that's the main thing to focus on. So you have these oscillations around the trend, but once the trend is a positive trend, that's the important takeaway. So this second question on cyclicality, you may tell me, Alex, I'm a potential investor, I'm a potential trader, but I'm fearful that if I make an investment or I make a trade, there will be a sell-off or there will be a recession. Understand cyclical factors and its implications on the economy, on securities, and view it similarly with the volatility question. View it from a lens of profitability. You could use cyclical factors, you could use analysis on the market cycle to guide your investing. A way that you can do this, for example, is you examine which sectors tend to perform well in the varying phases of the cycle. You could also do analysis and you can identify when there will be a shift from the current phase to the next, and you can position yourself for that upcoming shift. Now, this is easy to say, very difficult to do. And to get right consistently over time. So I'm focused on energy securities, financial securities related to energy. And the energy sector, energy stocks tend to perform well in the earlier part of the cycle. And then you could refine that, you could zoom in, and there is a concept known as the industry life cycle. And that charts an industry from inception to decline. And you could also narrow your opportunities, the universe of opportunities, by using this particular frame. Whether you're an asset manager or you're a retail investor or retail trader, you need to track and you need to follow these basic macroeconomic considerations and map them to market movements and incorporate them in your decision making. The mere fact that the market is a cycle and the mere fact that there are cyclical factors that you need to consider is not in itself a barrier to investing. You can have winning trades, you could make money, you could be profitable across the varying phases of the cycle. Now, an important distinction to make in the face of volatility and economic cycles is that of paper losses and realized losses. If you follow JB, Jordan Belfort, who is portrayed in The Wolf of Wall Street, his book, Wolf of Investing, has a humorous but insightful first chapter, the story of Fernando and Gordita. And let me reach for it. I have it here. Yeah, this is another recommended read, fun read as well. And it's a story of ill-timed investments. So a category of bad trades, we're looking at ill-timed investments. And in the story, Fernando had executed trades that had a sense of timing similar to Napoleon invading Russia in the dead of winter. and he had realized a loss on most of his portfolio. His wife wanted them to close out the remaining positions. They already had a substantial realized loss, but they had a few positions open, and those positions were showing a loss only on paper. And his wife was of the opinion to let's put this negative experience behind us and close out those remaining positions. And that would be converting the remaining paper loss into a realized loss. So how do you, as a trader, perceive paper losses? And when should you close out your position? You may reason, and it's very tempting to reason in this way, that the loss on the open position remains only on paper and price action can once again move in your favor over time. And in the book, Jordan Belfort references the institutional approach and the importance of marking to market, emphasizing that when you're down, it's a loss. And reflecting back on my own days when I started to retail trade, I was in the UK at my business school where I specialized in energy finance. So I was, when you are retail trading, you're generally dealing in CFDs or spread betting. And I was spread betting on oil price. And I remember having losing positions and thinking the market is going to move again in my favor. Let me keep it open for a few more minutes or a few more hours, because this is day trading, right? You're trading within the day. Very tempting, but again, I mentioned a concept in earlier episodes, your investment thesis, right? You have done your analysis, you have an investment thesis that guides you. And holding on to this losing position when it's not supported by your investment thesis is flawed. So the question of selling or not selling should be guided by your analysis that supported the trade and your justification that a profit can still be made with key drivers reasoned out. So you need to identify those key drivers as to why will the market be moving back into a favorable direction for me. And it needs to be within your investment thesis. Right? It should not be on a simple whim that it must inevitably go up again. You're better off betting red or black on a roulette table. Related to executing a well-timed trade is the debate around fundamental versus technical analysis. Now, I say versus, but a trader can benefit, is my opinion, a trader can benefit from both fundamental and technical analysis. And when I was, and I still am technically, when I am in my shoes of an oil trader, you benefit from both fundamental and technical analysis. Technical analysis does not receive the warm academic hug from theories such as the random walk or efficient market hypothesis. But you have the science of art and the art of science. And studying price action itself, the historical market activity, and investor psychology can add value, right? You have biases from individuals being stuck on historical data that can lead them to underreact to the news. You have people selling winners too early because they want to realize gains and hanging on to losers too long to correct the paper loss. This is something we touched on earlier. People may overreact through hoarding. And if you were into horse racing as well, this is equivalent of having a horse performing very well and then you placing your bet based on the recent performance of the horse. And people also tend to look for information that validates an existing belief. Right? So if you are a sound economist and you could analyze demand and supply factors and can produce a very good forecast of future price movement, but you may also be the individual that fails continuously to produce a winning trade. And that is because technical analysis delivers insights on when to enter and when to exit the market. Market timing is very important, particularly when we are discussing derivatives, where a buy and hold strategy has a limited viability on its own. So to develop a winning trading plan, you need an accurate forecast that is executed in a well-timed manner, and your arsenal will benefit from both fundamental and technical analysis. I'm keeping track of the runtime, so what I'll do is touch on one more theme and then leave the rest for the next episode. So quickly, I'd like to touch on valuation in the market. Valuation and the price someone is willing to pay has always intrigued me. In my energy career, one of the areas I focused on was crude oil valuation and trading. In the securities realm, my introduction, like many of us, came from Benjamin Graham, Warren Buffett, and perhaps less typical BlackRock's Andrew Ang. And in a 100% efficient market, a product would be priced at its fair market value. Valuation would serve to explain the current market price. I love the market, but it's not perfect. And you can capitalize on its inefficiencies. You can capitalize on its mistakes. And passive investing, where you're placing your capital in an index fund, has proven effective over the long run. And we need to also be reminded with that comment that passive investing, I'm speaking about here in the US, passive investing in the US economy, that has been on this positive secular trend. Important to note that a secular trend can shift, similar with a long-term cycle or a short-term cycle. And you need to be mindful of when a shift from positive secular trend to a negative secular trend may occur. The average retail investor will fail to beat the index in the long run. And you can get lucky with the performance at the institutional level, let's say a mutual fund in 1 or a few years, but there's no guarantee of future performance or further performance. And if you're retail trading, the odds are really stacked against you, right? So as I said earlier, the market is not a perfect place, but you can profit from identifying inefficiencies and mistakes. And with that, I leave you on this third episode of RIVEM Outpace FS. And until next time, I'll see you then.